When will the Fed lower rates again? Hey everyone, Diana Renee here with Keller Williams Real Estate. Throughout 2022, mortgage rates have more than doubled, sending affordability and demand in the housing market down sharply. With lower demand, lower prices often follow, which is why we're in the midst of a housing market correction. I believe this correction has been caused primarily by rapidly rising mortgage rates and will last for as long as rates keep rising. The question then is, what will happen to mortgage rates next year? Given that the Fed closed out the year with a 50 basis point increase mid-December, many are expecting mortgage rates to keep rising into 2023. The Fed has stated that they intend to keep raising the federal funds rate into the beginning of next year. This has many expecting mortgage rates to shoot up to 8% or even higher into 2023. However, many prominent forecasters are calling for mortgage rates to drop in 2023. The Mortgage Bankers Association expects rates to end in 2023 at around 5.4%. Economist Mark Zandi expects rates to fall modestly to 6.5%. Logan Mohtashami thinks it's feasible that mortgage rates will come down next year. What's all that about? If the Fed has told us they're raising rates and there's all this economic uncertainty, how could rates fall? I know this seems crazy, but this forecast has economic logic, so we should definitely look into it. First, we must remember that the Fed does not control mortgage rates. When the Fed says they're raising rates, they're talking about the federal funds rate, which informs but does not control mortgage rates for credit, nor credit cards, car loans, etc. So while the Fed only indirectly impacts mortgage rates, they are directly impacted by the yield on the 10-year Treasury bond. The correlation between the yield on the bond and mortgage rates is super high at 0.99. But you don't need to do any math to understand that. You can see that in this chart. Mortgage rates and the 10-year bond move together. The 10-year yield and mortgage rates move lockstep because of how banks make money and manage their risk-reward profile. Imagine you're a bank with billions of dollars to loan out. Every day you have to evaluate who to loan your money to, how risky each potential loan is, and what profit or interest rate you need to earn in order to compensate for the risk. The interest rate on the loan goes up according to how risky the lender deems the loan. The least risky loan in the world is lending to the U.S. government in the form of a bond called a treasury bill. That's all a treasury bill is, a loan to the U.S. government. And it's very low risk because the U.S. government has never defaulted on its debts. To date, the U.S. has made every single bond payment it's obligated to pay. So it's very low risk for a bank or any other investor to hold U.S. bonds. Right now, the yield you earn on a 10-year Treasury security is about 3.6%. So a bank can earn 3.6% interest with pretty much no risk. But banks want to earn more than that. So they make loans to businesses and individuals, often in the form of mortgages, in addition to buying treasuries and lending to the U.S. government. Mortgages are not particularly risky in the grand scheme of things, but any person taking out a mortgage is still less creditworthy than the U.S. government. So if the bank is going to lend money for a mortgage, they are taking on more risk than they would if they instead lent the money to the U.S. government. To compensate for that increased risk, the bank is going to charge you a higher percentage rate. Typically, the bank charges about 170 basis points over the yield on the 10-year Treasury bond for a 30-year fixed mortgage. 170 basis points equals 1.7%. So the big question is, how could mortgage rates fall in 2023? There are two theories. First, bond yields could fall and take mortgage rates down with them. Many economists are predicting a global recession in 2023. During a recession, economists tend to look for low-risk investments. And as we've discussed, the lowest risk investment in the world is a U.S. Treasury bill. This surge of demand for U.S. Treasuries could drive up the price of bonds, More demand equals higher prices, which drives down yields because bond prices and yields are inversely related. So, the main reason mortgage rates could fall in 2023 is because we could enter a global recession, raising demand for US Treasuries, which sends bond yields and mortgage rates down. The second reason mortgage rates could fall in 2023 is due to the current spread between yields and mortgage rates. Remember when I said that banks charge mortgage borrowers a premium on top of bond yields due to excessive risk, and that premium is usually 170 basis points? Well, right now, that premium is 292 basis points. That's 72% above normal spread. The spread tends to increase when there's a lot of economic uncertainty. Just check out the graph. Since 2000, the spread has gone significantly above 200 basis points just 3 times: the Great Recession, the beginning of the pandemic, and now. The current spread is the highest it's been since 1986. We're still in an uncertain period, but over the course of 2023, things could become more clear. At least let's hope so. If inflation starts to come down and the Fed pauses or even reverses its rate hikes, I would expect the spread between the 10-year yield and mortgage rates to normalize a bit, which could bring down mortgage rates even if yields stay high. So in conclusion, of course, I don't have a crystal ball, but it's important to understand that there is a reasonable scenario where mortgage rates fall in 2023. We're just going to have to wait and see what happens with inflation to know which way mortgage rates and potentially housing prices will head next year. For more information, click the links below for more details on the housing market. If you would like even more info on the housing market, please give me a call. I'm a huge data nerd. I love to talk about the real estate market. Real estate is my passion. I'm happy to offer advice or a market analysis of your home at no cost. Oh, and by the way, if you or anyone you know is interested in selling, buying, or investing in real estate, please give us a call. We're happy to help. Have a great week, everyone.